Sustainable business models do more than make money. They must have environmental infrastructure in place to help them meet targets to prevent pollution, minimize costs, and mitigate climate change. Sustainable Development Capital, or SDCL, invests in energy efficiency and local energy generation projects with a number of well-known big blue-chip clients. Welcome to this edition of IG Trade in the Markets podcast. I'm Jeremy Naylor. I'm talking today to Jonathan Maxwell, founder and chief executive of Sustainable Development Capital, or SDCL, which manages the SDCL Energy Efficiency Income Trust. Jonathan, welcome. First of all, how long has it been an area of interest for investors?
I think energy efficiency and sort of on-site generation has been a theme of the energy industry and energy market for a lot of the last 20 or 30 years. I think during the last 10 years, uptake of solutions around energy efficiency, so reducing energy demand inside buildings, or and also supplying them more efficiently than the grid. Over the last decade, we've seen a sort of very tremendous increase in deployment and scaling up within the industry, and I think that's why investors' attentions have really been grabbed, in particular in the last 2 or 3 years, because the scale of the opportunity has really, I think, risen to the surface of attention for a lot of investors.
How big is the market then that you're aiming at?
If you take a step back, most of the interest in the clean energy investment sector has been around renewable energy connected to the grid. So we've seen an enormous marketplace there, $5-9 trillion market, according to the International Energy Agency. But if you take the same view and you look at where that energy goes, most of it goes to buildings and transport. So 60% of all the energy in the world is used either in buildings, 40%, or transport, 20%. So that story, actually, the end user story, where does it end up? The energy is probably the largest part of the energy market. And indeed, the International Energy Agency has estimated the size of the market of anything between 10 and $29 trillion dollars. So it's actually a very substantial marketplace.
Is that the total potential market? I mean, we're talking here about a business that's, quite frankly, in its infancy, aren't we? I mean, we're presumably got a lot of upside to grow into from this point.
I think the way that the energy market has worked in the past has been around, concentrating on centralized energy generation, traditional sources of power, some quite often from fossil fuels. And I think we've seen a shift, or a transition, if you like, in the energy mix towards cleaner and more renewable sources over the course of the last 5 or 10 years in particular. But I think the future, as far as we believe, is going to include, and to some degree rely on, decentralization. What we mean by that is bringing energy right to the point of use. The reason is that up to two thirds of the original energy used in any economy can be wasted before it gets to the point of use through generation, transmission, and distribution. So bringing energy generation to where it's used is a big part of the solution to that problem. And meanwhile, buildings can waste 25% of the energy that they use. So again, improving efficiency of buildings is a huge part of the solution for the next decade. So we think people are going to hear a lot more about energy efficiency and decentralization.
That's interesting, because my understanding is there is little or no efficiency in the UK's centralized system, as you say, of generating power, then using a distribution network to use a grid to distribute that. How do we get around that? I mean, that's not your job, presumably, is it? Are you just using what's available, or are you involved in helping that process?
Well, we're involved in two ways. One of which is bringing energy directly to the point of use. So we invest in energy generation, that is the provision of power and heat that's low carbon, directly at the point of use in industrial facilities. So, for example, in the United States, we have a large portfolio of energy centers that deliver energy directly to the point of use in the steel industry, right across commercial and industrial clients. In the UK, we bring energy directly to the point of use. For example, we have a major project with Tesco's about putting solar panels across their buildings nationwide. We have some great projects running here and in North America with the likes of Citigroup, where we provide on-site generation. So it's actually first port of call is to bring energy directly to the point of use, bypassing the inefficiencies of generating energy and wasting heat or output, bypassing the transmission and distribution system and bringing it directly to the point of use. So that's one big area, and we're excited to see new technologies coming through the system for on-site heat generation as well as power. The second side of the coin really is about reducing the amount of energy inside buildings, and we've invested in major projects to reduce energy wastage inside buildings. Great examples would be we funded the retrofit of all the lights in all the buildings all throughout the UK, for example, at Santander Bank. We have projects in over 30 states in the United States that also fund energy efficiency retrofits for major corporate and industrial clients.
Let me just pick up on that point then, talking about Tesco, for example. You provide these solar panels so that they can be more efficient. I mean, that to me seems like a good incentive for Tesco, because presumably they are ultimately saving money on this particular area. Whereas some of what you are trying to do, presumably, is to try and help some of these companies reduce their carbon footprint, which doesn't have any benefit, does it?
Well, there are three things that we look for in every project that we invest. And it's usually all three of these things. The first is low carbon. So yes, using renewable power or highly efficient energy systems directly at the point of use. We look to ensure that the energy solution is lower carbon than the grid. The second key feature that we look for in any project is cost efficiency. We were really excited when solar power became as cheap, if not cheaper, than the grid for retailers like Tesco's in the UK. That was a huge turning point in the market. So we started investing in solar, and in fact, we've just before Christmas, we signed a deal where we've entered into a 50-50 partnership with Blackstone and become one of the larger commercial and industrial solar players in the United States. So we see solar as a great technology, but it's because it's cost effective as well as low carbon. But there's a third benefit, which is that generating energy on site for major corporate and industrial clients can actually improve the infrastructure, the security of supply, or the resilience. So, for example, reducing the reliance on the grid also reduces the risk that if there are grid outages, then there are problems with energy supply on site. So we say that there are really three things that we look for in solutions that are cheaper, cleaner, and more reliable.
It's an interesting point. I mean, in this country, where compared to some parts, certainly in the United States, we don't get as much sun, to what degree in all honesty, are solar panels an efficient way of dealing with all this? I mean, trying to generate power through sunshine when you don't get as much as some areas of the world must be difficult to sell to these big blue chips, isn't it?
I think it's all about the price point and the efficiency and reliability with which you can deliver the end solution. So even in the UK, which is not world famous for being the sunniest country, we can produce energy, power that is, for major groups like Tesco's at the same price, if not cheaper than the grid, even with the sunshine that we have here in the UK. And what that attests to is the cost competitiveness of solar panels and the efficiency of delivering that energy directly to the point of use rather than through the grid. I mean, in other countries like the US, obviously, it's very geographically dispersed, our portfolio. We have solar panels in most states actually now in the US, some of which are sunnier than others. But in all cases, it's cost effective to deliver. However, technology selection also goes to what the end need is for the customer. If it's power, that's one thing. If it is heat, clearly we need to use other technologies.
Now, I said at the top, you have the management of the SDCL Energy Efficiency Income Trust. Is that a completely separate part of the SDCL group, if you like? Because you invest with these companies, you sell to these companies opportunities, then you invest money. Is that all a separate part of the business, or how do you bring the two together?
Sure. Well, SDCL is the investment manager of the SDCL Energy Efficiency Income Trust. The trust is an investment company. It's listed on the London Stock Exchange on the main market. It has a market capitalization of about £750 million. and it has a broad range of investments across the UK, North America, and Europe. That we manage that company, we make the day-to-day investment decisions. Now, I mean, SDCL has other capabilities which allow it to originate and construct projects, but our investment management role with SEIT, that is the SDCL Energy Efficiency Income Trust, is the largest investment company that we manage, and it's focused predominantly on investing in established operating energy efficiency projects in major global markets like the UK, the United States, and Europe.
Where do you see this going? Clearly, if you look at the chart last year, the deep COVID crisis back in March, like a lot of businesses, you had a big spike down. Then there was a recovery.
Yeah.
And it's been a fairly stable investment environment so far as the chart is concerned for the income trust. What is it that could stir the upside from this point? Or are you just in it to continue to turn over what you're doing and delivering shareholder value through dividends?
Yeah, it's a great question. I mean, we experienced a good degree of resilience last year across our portfolios, including the SDCL Energy Efficiency Income Trust, in the face of COVID. It was resilient, our portfolios, because we're providing, to the point I made before, cheaper, cleaner, more reliable energy solutions directly to the point of use. And our users are big corporate and industrial clients, usually household names or government counterparties like hospitals. So, throughout the COVID crisis, notwithstanding, national lockdowns, the assets that we were providing energy to, that is, our manufacturers, the hospitals, the data centers, the steel mills, kept on going through COVID. We in fact, we described that process as that we were providing essential energy services to essential industry, essential as part of their economy. So we had a very robust, resilient 2020. But in terms of where we see this going forward, I think there are two things. One of which is to the point we made at the beginning. The energy efficiency and decentralized energy market is at the beginning of a very significant decade for growth. We see tremendous emphasis on decentralization and efficiency coming into the system. And then as far as our portfolios are concerned, certainly we'll be looking to add to those through new investments, which are accretive to our earnings and our dividend paying capability. We have a dividend yield of just over 5% today. But, I think the other key point is that we've already made a substantial number of investments. For example, we own the gas grid in Stockholm, which is a predominantly biogas. In terms of where we're taking it, it's currently 70% biogas. We're going to take it to 100% biogas and increase the capabilities of that network in Stockholm to deliver other services to residents and commercial industrial customers in the city. So we've got, we believe, some very good opportunities to add upsides. We own 125 megawatts of existing generation in Spain, where we're a big heat provider to the olive industry. And again, we can see some substantial upsides. And again, coming back into the United States, to the discussion we had before, we have a very substantial portfolio of commercial industrial solar projects. We have on-site generation projects across the Northeast US. And we're looking at making further investments in North America. And we definitely see upsides associated with the existing asset base. So I suppose there are two things, one of which is managing our existing assets and driving growth and additional revenues out of them while keeping costs stable, number one. And then number two, looking to make new investments where we really see great opportunities. And to the point we made before, we actually think that this end of the market could actually be larger than the renewable energy sector, although, not to be facetious, we think it's been largely overlooked by the investment community and therefore a very interesting opportunity for growth.
How do you make those investments? Do you borrow money? Do you use cash? Do you then try perhaps maybe to shift some of your dividend away back into the business and explain it away to investors by saying, well, it's growing the business? How do you go about investing in your opportunities?
So we usually invest predominantly equity in our new investments. We have used acquisition debt financing to support some of our investments in the past, but it's most often equity acquisitions. We've done that through raising capital in the market historically. And we had a very successful fundraising a few weeks ago on the London Stock Exchange, where we had an oversubscribed issue and upsized our offering to take that into account. Generally, we've been able to invest prudently and well promptly after any capital raising. So we usually raise capital when we know we're highly likely to be deploying capital into high quality projects in the relatively short term. Now, we've had a number of new investments recently. We're in the process of making new investments right now, according to the last announcements we put into the system. So we will look to carry on this year doing those two things that I pointed out, one of which is focusing on enhancing the value of our existing portfolio, and then second, selectively making new asset acquisitions where we see value in the market.
So who are your competitors then in this area?
It's quite a broad marketplace. Traditionally, financial investors, as I said, have been more focused on investing in the renewable power market generally. We are starting to see some insurance companies, pension funds, and asset managers taking a look at some of the opportunities in this sector. However, we find when we've made our investments recently, we're able to distinguish ourselves by providing a capital solution to be able to accelerate investment as well as simply acquiring assets. For example, the deal we did with Onyx Renewables in the United States is a great example where we can put our capital alongside a development platform to really accelerate the velocity of their business, as well as delivering attractive projects into our portfolio at attractive returns. So we take a slightly different approach to the traditional investment community. We tend to combine both technical and investment capability within the firm here. So again, we can enter into situations that would usually only be looked at by strategic players like utilities or power producers. So we try and make ourselves value add and try to avoid the word competition, but try to sort of distinguish ourselves with value add to developers or to vendors, by being able to come to the table with a combination of technical and financial expertise. And that really helps distinguish what we're doing from, the mainstream.
Just to wind it up then, we're just approaching the end of the first quarter of 2021. How do you see the rest of the year going?
The end of the year is going to have COP26. It's the UK's hosting of the climate change conference. The reason I mention that is that the last decade, I've seen massive growth in the energy efficiency and decentralized energy. What I would characterize a big change, though, of the last 6-9 months in particular, is that policymakers have really seized this agenda. We've seen it last week in the industrial energy strategy from the UK. We've seen it last summer from the European Commission, what they call the renovation wave, which is an initiative to retrofit 34 million buildings across Europe because they realize that building efficiency is going to be critical to decarbonisation. And we've seen it now in the United States with the new incoming administration, again focusing on energy efficiency, including the retrofit of 4 million public buildings. So my own view is that while the market will continue to grow from market forces because these solutions are cheaper and cleaner and more reliable than business as usual, the big shift is the policy change, what I call a policy earthquake, really, which is Europe, the United States, and even the UK, recognizing that the future for decarbonisation is going to include efficiency and decentralization. And on that basis, I think that a lot of the story of the next 2, 3, 4 quarters is going to be driven and encouraged by policy, whether it's in buildings efficiency, it's in new technology like hydrogen I think we've got a lot more to come, and we're very excited about being in the right part of the market.
Jonathan, we'll have to leave it there, but thanks indeed for joining us. That's Jonathan Maxwell. He's founder and chief executive of Sustainable Development Capital, or SDCL, which manages the SDCL Energy Efficiency Income Trust. If you want to hear more from IG Trading the Markets podcast, please subscribe. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.